Now, maybe it was always this way, but it does seem like now more than ever, there's a massive disconnect between investing success from the perspective of the financial industry versus success from the perspective of the clients themselves. We all know that the big banks and financial institutions, Wall Street, they're doing great. They have enormous profit, they get huge bonuses, and when they make mistakes, they get bailed out. So there's very little consequence. But what about clients? Are their returns also on the rise, and do they get reimbursed when there's drawdowns in their portfolio? No, of course not. They bear most of the risk, but reap few of the rewards. Now, this isn't an indictment on the entire financial industry. Of course, there's plenty of good people out there doing really good work and getting a consistent rate of return for their clients. But it does need to be said that the majority aren't. Now, just to frame this correctly and give some context, and this isn't an exact science, of course, but roughly 85% of fund managers out there underperform their benchmarks. And because the S&P 500 itself is one of the top performing benchmarks, it would be fair to say that at least that many are underperforming the S&P. So what kind of rate of return are we actually talking about? Here's a basic S&P 500 return calculator. And as you can see, over the past 20 years, the S&P 500 has averaged 4.6% a year. If you reinvested all your dividends along the way, it gets bumped up to 6.5% a year. How many of you were surprised by that number? And it actually gets even worse because that doesn't even account for inflation. Over the same time period, and now adjusted for inflation, the annual return drops to just 2.3%. And even if you reinvested all your dividends, it's still only 4.2% a year. And it's important to note that that rate of return is measured with the S&P 500 currently at all-time highs. So a case could certainly be made that the next 20 years may not be much better than the previous 20. And I don't want to get too grim here, but are bonds any better? With interest rates currently also near all-time lows, what are investors supposed to do? If stocks and bonds are facing a low single-digit expected return, we may have a problem here. But I personally believe that despite the fairly depressing situation that's facing the average investor out there are ways to get a decent rate of return, even if stocks and fixed income continue on their current trajectory. But it does require some out-of-the-box thinking and some fresh ideas. So in this video, I'd like to introduce the Total Portfolio Solution, my alternative to traditional portfolio management. Let me get into some details. Traditional portfolio management will typically be a buy and hold style portfolio made up of stocks, bonds, commodities, or precious metals, and maybe some real estate exposure. Of course, it'll be further diversified into domestic and international, large cap, small cap, different bond durations, but for the most part, it's just a simple pie chart of traditional asset classes. But we already know this hasn't worked out very well for clients. After paying out management fees, it's likely going to be a low single-digit rate of return in the long run. Now let's take a look at the Total Portfolio Solution. Instead of asset classes, my solution is to allocate smaller portions of the portfolio to independently traded strategies. The core allocation is the VTS Tactical Balance Strategy, which rotates between stocks, bonds, or gold, depending on market conditions. In stable periods, we're holding stocks. But when markets start to break down, we'll move into bonds and gold. The VTS Tactical Volatility Strategy takes long and short positions in volatility ETFs. I'll get into what that means in a few minutes, but the strategy is 25% of the portfolio. And lastly, the VTS Iron Condor strategy is a simple derivative strategy that profits when markets aren't trending strongly in either direction, which as it turns out is most of the time. The black line is the S&P 500, which makes for a good long-term investing target because, as I mentioned, the vast majority of investors are actually below that. I include a broad hedge fund index as well because a lot of people out there are under the impression that because hedge funds make big money and represent the cream of the crop in the investing world, that must mean their rate of return justifies their fees. I'll let you draw your own conclusions on that one, but Warren Buffett actually has a running $1 million bet that his chosen index fund would outperform his friend's hand-picked basket of hedge funds. That bet is in year 9 now, and needless to say, Buffett's chosen index fund is miles ahead of the basket of hedge funds. Anyway, the purple line here is the Total Portfolio Solution. 3 strategies, independently traded, all of which have their own risk management built into them. Whenever looking at statistics like this, it's easy for people to get focused in on that annual return. As a default, people tend to just compare how much they can make. And in this case, sure, double the annual return of the S&P is attractive, but I would suggest people focus more on a few of the other statistics here. First and foremost, the Ulster Performance Index. This is a measure that takes into account risk, consistency of performance, and magnitude of drawdowns, and the higher the number, the better. In my opinion, this is the single best metric to gauge how it's actually going to feel when you're investing. As much as we'd like to think we're cold and calculating in our trading, in reality, emotions do play a pretty large role. So sticking to strategies that have a high Ulster Performance Index is a great start. Also, having a manageable maximum drawdown is very important as well, because there's going to be times in the future when things go badly. That's just a fact. Markets don't always cooperate, but demonstrating an ability to reduce drawdowns to a manageable level, again, smooths out the emotions that come with investing. And lastly, because we already know what happens to equities during recessions, and considering that this is in fact the second longest bull market in history, having strategies that aren't highly correlated to the stock market is valuable. Remember, it was only 9 years ago that stocks crashed 55%. And you can see here, for example, the hedge fund index is 86% correlated. I don't think anybody's going to be surprised when hedge fund performance falls with the stock market during the next recession, whenever that is. So we have to keep this correlation lower. So now I want to briefly go through each of the strategies that make up the diversified portfolio, starting with the VTS Tactical Balanced. Each of these individual strategies have their own dedicated video, so if you want to dig a little bit deeper, I invite you to watch those later on. But what I want to cover here is how each strategy deals with the possibility of a market decline, because that's really at the heart of the problem with traditional portfolio management. There's nothing wrong with stock market performance during bull markets, but recessions do hit, and the drawdowns can be very severe. As I mentioned, the S&P 500 lost 55% in the last one. And buy and hold investors are going to feel all of that. So I specifically design each of my strategies to have some kind of answer to an extended market sell-off. In this case, the tactical balance strategy does take stock market positions during the majority of a bull market. Starting in 2009, a lot of this is because of the stock market recovery. But we can't rely on stocks to just go up forever, so having mechanics in place to move into bonds and gold when markets don't cooperate is really why I have confidence in the long run. Since the financial crisis in 2008, there's been two major drawdowns. The first in 2011, during the European sovereign debt crisis from August to November. That was a rough period for stocks. The S&P 500 dropped over 18%. But the balance strategy can move into bonds and gold during periods like that, reducing the risk, and in this case actually came out a little bit ahead. And another starting in August of 2015, this was the second biggest drawdown. By mid-February of 2016, stocks were down over 13%. The balance strategy during that same 7-month period was again up a little bit. History doesn't necessarily repeat itself, but the point here is that the tactical balance strategy does have mechanisms in place to move out of stocks and into something safer when trouble arises. And it makes up 50% of the total portfolio solution. Now moving on to the strategy that gets the most attention, the VTS Tactical Volatility Strategy. Again, there's a video here you can check out for more details, but what I'll focus on is how the strategy reacts to different market environments. This is a strategy that tactically allocates to positions in either the XIV, the VXX, or cash. During bull markets, the XIV portion of the strategy, that's the short volatility position that profits when market volatility declines. During those periods, it does extremely well. But markets don't always go up, of course, so during declines, cash, as well as long volatility positions in the VXX, play a larger role. Just like before, though, it's not enough just to have a high annual return. Drawdowns also have to be reasonable. And we need a high Ulster index with a low correlation to the stock market. Let's take a look at those two largest stock market drawdowns. The European debt crisis, August to November of 2011, again profitable. Expect a lot of cash positions during periods like that, as well as some long volatility VXX. And of course, this will be even more important during the next recession. The second largest drawdown, August 2015 to February 2016, between being safely in cash and strategically in the VXX, again, that serious equities drawdown turned into a profitable period. Now, because I've been trading volatility products a long time, I've seen both sides of this, good times and bad. And I truly believe the best way to trade these inherently risky products is conservatively, with plenty of cash positions along the way. I'm a little worried here that because there's so much potential here for large profit, we're going to see the same pattern we always see. People are going to pile in, they'll get overly aggressive, they'll take too many trades, some will even use leverage, and in the end, they'll end up turning this golden opportunity into a liability. But I'm more conservative in nature with a long-term mindset. The strategy's in cash over 50% of the time, and it only makes up 25% of the total portfolio solution, which leaves plenty of opportunity for profit, but it's also being mindful to the risks. The last component of the diversified portfolio is the VTS Iron Condor strategy. Because this is a derivative strategy, it's actually quite simple and easy to follow, but option trading does require a little bit more explanation, so there's several videos here you can check out, as well as a 6-part Iron Condor 101 series in my blog. Keeping with the ongoing theme here, I focus on reducing drawdowns and smoothing out performance in the long run. And again, we'll focus on the important statistics of a lower drawdown, a higher Ulcer Performance Index, and a low correlation to the stock market. So that's the total portfolio solution. 3 strategies, all of which have both bull market and bear market mechanics in place. This is the best way I know of to smooth out performance and actually get an acceptable rate of return in the long run. Now, I know some of you are watching this thinking, boy, volatility trading, I really don't know what that is. Or derivative trading, iron condors, that sounds complicated. Believe me, I get it. This isn't what you would call traditional investing, but we already know that traditional portfolio management isn't working, at least from the client's perspective. So we need a little non-traditional. We need some fresh ideas. And the total portfolio solution is my best effort in that regard. None of the strategies are very active. It's just a few trades per month on average, so it's really just a couple of minutes a day at most to follow along. But if you do have a really busy schedule, we have auto trading available to make things really easy. But of course, education before action. So I invite you to check out some of my other videos, learn more about the individual strategies, as well as just my general investing philosophy. Check back for new content. And of course, if you ever have any questions, feel free to contact me anytime. I'm always here to help. Thanks for watching. So go ahead and click the link right here, sign up for the VTS newsletter, and when you do, you're going to get full access to all 3 of my trading strategies for a full 2 weeks absolutely free. And if you are new here, please consider subscribing to my channel. Also, if you have any questions or comments, I'd love to hear from you, so go ahead and leave those in the comments section. See you next time.